Hey, good evening, everyone. Marty Mazzora here. It's Tuesday, the 21st of February, 2023. This will be your midweek stock market snapshot. Normally do this on Wednesday, but tomorrow's calendar kind of gets in the way of that. In fact, I think I'll make this the morning message tomorrow morning as well. So happy Wednesday to you, because that's when you'll be seeing this. So going to look at just the S&P 500. Want to take a look at the VIX as well and keep it relatively quick tonight. But as I usually do, I'll just kind of start with our basic narrative, if you will. These presentations are really just meant to give you a snapshot of how the market is set up technically at the moment. Typically the stock market, but at times we do get into currencies, we get into commodities and other things, and we'll do more of that in the future. But probably for the last few weeks, if not months, we've been focusing primarily on what people are interested in, and that's the equity market. In terms of how we see the world here short term, the market has been selling off a bit lately. If you believe the headline, it would be, inflation heating up. We got a hot jobs number. CPI came in a bit hotter than expected. Hawkish commentary from a couple of Fed governors here recently, inconsistent with at least what the Fed chairman intimated during the press conference of the recent Fed meeting, and he mentioned disinflation something like 11 times. And the market loved that. Well, since then, the data hasn't really supported that. This week, we have the Fed minutes for that meeting tomorrow. At one point during the press conference, he was asked if during the meeting they discussed a pause. He wouldn't answer that question. And he said, you'll find out in the minutes. I actually initially interpreted that based on other things that he said that, yeah, they probably did talk about a pause, and maybe he just doesn't want to give the market even more juice to shoot higher on. But listening to Bullard and Mester here recently, suggesting that they were actually advocating for a 50 basis point increase at the last meeting. Maybe he didn't want to say no and have stocks roll over pretty hard that day. So we'll see. I guess we'll find out tomorrow. The market seems to be geared up based on today's action for a disappointment, hawkish minutes, if you will. Later in the week, we have GDP. At the end of the week, we have PCE, personal consumption expenditures. Part of that is a deflator, which is the inflation indicator that the Fed supposedly puts the most weight on. So if CPI and PPI were any indication, well, then PCE is going to come in pretty hot as well. That could be a problem for the market. Now, fast forward, say, the next 3 to 6 months. If you're in the recession camp, which we are, well, then disinflation is what we're going to get. Plus base effects over the next 3 months in particular are going to lend themselves to softer inflation readings, right? So based on how the market trades, based on how it traded at 9:45 Eastern time this morning, when S&P Global's US PMI came out, back in expansionary territory after 7 months of being in contractionary territory, and watching the market just roll over hard on that news, tells you that it's still trading on Fed expectations. Now, by the time we get to where you would legitimately expect the Fed to maybe start thinking about a cut, if you will, if not just a pause, those are going to be conditions that are quite a challenge for corporate profits. And again, remember, our base case is that the first leg of the bear market, which took us down to our initial target of 3,500, which we made before we were in the recession camp, was all about valuations coming down because interest rates were going up. I can say it that simply. The second leg that gets us closer to our new target, which right now, for what it's worth, is 3,200, is based on earnings contracting with a recession. So I actually think, believe it or not, that if that setup really begins to show up not too far into the year, well, then we actually could have the Fed actually cutting interest rates, and the recent discounting of Fed funds futures, which would be a cut or two later in the year, could very well turn out to be right. That's no reason to get crazy bullish, because the conditions that would make that happen would be recessionary conditions. From a longer term perspective, though, we really have a structural inflation thesis, which we believe to spell something more of the lines of perhaps 3 to 5% long-term annual inflation going out years. But of course, in a recessionary scenario, the Fed's going to hit its target and some to the downside. When we square it all up and we look at where governments are going to be focusing their attention going forward, when we look at what we believe will be a dollar that trends lower over multiple years going forward, we think we have a macro setup that is absolutely rich in opportunities. So as I've said multiple times of late, the next 5 or 6 months look precarious to us. The next 5 to 6 years plus look hugely opportunistic. If you understand the macro backdrop, intermarket relationships, you can find those opportunities, and we think they will be significant. And we think that in terms of equities, they largely lie outside the U.S., and they largely lie within specific spots on the commodity chain. But for the moment, we think recession's coming, we think earnings are coming down, and we think stock prices ought to come down with that, giving us the opportunity to add to what we believe is going to work at better prices than we have right now. Now, of course, that's just the world as we see it today. Things can change and our thesis can change. We just think right now the risk-reward setup is precarious, and we'll keep giving you our thoughts as we go along. So in front of you is the hourly chart for the S&P 500. Recall that during at least the last couple of presentations I've done here, I pointed to this consolidation pattern right here, and it compared it to the one that goes from, say, mid-December into early January, right? And we were flagging this even back then, and you may recall, regular viewers, that we were noticing a pretty bullish trend developing underneath this consolidation pattern, and odds really favored an upside break. So we got that. We retested the top here, very normal, and then we had a pretty good run, right? But right early on, we started developing a rising wedge with negative divergences, particularly on the RSI, and so we got a little corrective action in there, bounced once again, so tested that area once again at 38.90, bounced off of that, and then moved into this consolidation pattern. But look at the difference here. So consolidating sideways, but very definite bearish divergences here. So basically the opposite of what we saw here in this consolidation pattern. So in here we were saying, looks like it's going to break lower. And sure enough, we got that. We got that with momentum. And that 4,000 mark, where the folks who we pay for their insight into what's going on in derivatives tell us there's just a tremendous concentration of option activity right there. So that could be, some support. If we break down below that, then we're looking at mostly existing put exposure, which would have the dealers, the sellers of those puts, the counterparties, if you will, having to do what we call gamma hedging, hedge their downside risk, which is shorting the underlying securities, and that could exacerbate something lower. So a not small tailwind for this rally so far this year actually has been going on in the options market. We had a lot of short interest coming into the year that continued to kind of cover and then go short again. And it looks like maybe a lot of that it's worked its way out. We had mutual fund managers coming in underweight equities, and even the latest data says that they still were. There's some career risk there. So if the market's going to continue to melt up, they're going to have to jump on that train. So that can provide, and maybe has provided, some upside oomph to the market. Well, now, maybe some of that's worn off, so we could see some real corrective action. Whether or not this is ultimately what gets us down to where we think stocks should ultimately be, maybe it's a little early, but breaking below that 4,000 with force and testing some of these levels makes a lot of sense to us right here. Again, ultimately, we think we go lower, but it would not surprise me if we were to replay only in the opposite of what we had here. Remember, We broke out of this, we came back, tested it, broke out, came back, tested it before we moved measurably higher. So who knows, maybe as early as tomorrow, we come back and we test this level, the bottom end of this consolidation, break down, maybe test it again before we go down as well. Or maybe we get right back into it and begin fighting our way through this consolidation area here again. But I think there is less support for this market here, and I'm certain of it below 4,000. Now looking at the daily chart, here's that earlier consolidation. Here's the one that we just broke out of. So again, pretty much the same look on the daily chart. Broke out, there's the blue candle. There's our bearish divergences playing out so far, right? Sell signal, overbought, just like we had here. Overbought, sell signal, just at close to it. And a solid break below the 20-day moving average. The yellow line, remember, as we explored, when we break above it with momentum, we seem to get good rallies for a bit. Break below it, corrections, right? Break above it, boom, break below it. For the most part, this 20-day has been something to pay very serious attention to, and we just broke down below that. So we'll see if we don't come back and retest the bottom of that and see if it becomes resistance. Pretty strong support right here. You've got the 50-day moving average, you've got the bear market trend line in red, and then you've got the 200-day moving average. Folks, you break below that, and 3,800 is virtually inevitable. And you could find some support there, as we've seen throughout the bear market here. So technically, still near term, I'm going to say bearish, but a bounce here off of these levels would not surprise me. And then we'll be talking about whether or not we're just going to test this or move back into this range. The market still looks very heavy to me in terms of upside potential from a technical perspective. Real quickly, the VIX. Remember what we did here when the stock market was giving us pretty ambiguous signals here of late. I was showing you the VIX, right? And there was nothing ambiguous about this. This was very bullish for the VIX, bearish for stocks, right? We had a downward sloping wedge and very definite rising divergences. And then sure enough, right in here, and this is your daily chart. Right in here, we broke out of it, came back tested it, and then we're kind of off to the races. And so again, the VIX is playing out just like the chart suggested, and the S&P is playing out, at least for the moment, just like the charts suggested it should. I'll leave it there. Stay tuned. Tomorrow's going to be very interesting. The rest of the week is going to be very interesting, and we'll update our charts at the end of the week or over the weekend, as we usually do. Thank you, as always, for watching and listening. Take care. Bye-bye.